Obamacare was to become Trumpcare, but nothing came of it. Instead, it was a teaching session on politics for the new US president. And he had to learn that winning election may not be so hard, but the governance of a country is very much harder. So, these are our topics in today's Werthstein Index update. What does Donald Trump's failure on health reform mean for his future plans on tax and spending and for the markets? And Brexit now cannot be stopped. So in 2 years, Britain will be out of the EU. But what will happen during those 2 years? And we ask whether investors believe in the Goldilocks scenario, meaning they expect the best of all possible worlds, but also meaning that there could be risks if things don't turn out perfectly.
It was the prestige project of his term of office, Barack Obama's healthcare reform. After 7 terrible years, as the new US President Donald Trump put it, everything would now get better. But just before Congress was due to vote on the bill, which called for massive cuts in Obamacare, the Republicans withdrew it at Trump's request. Donald Trump quickly switched to other topics, promising success in other areas such as the tax cuts he had announced.
Giles Keating, president of the Werthstein Institute in London. Trump failed with his first major test in his own house on his own guys. What does that mean for his other big promises, like the billions of heavy infrastructure spending and tax reform?
It does not bode well for those new measures. Of course, technically, they could still go ahead and cut taxes and boost infrastructure spending. But I think the failure on the healthcare has created a loss of direction, and it actually makes it significantly more difficult.
And now, going to Paris, Valérie Planiol, Werthstein Institute fellow. What do you think? Do we have already seen all effects of Trump's defeat on the markets?
Well, some of the Trump-euphoria has definitely faded, but I think that moving quickly from Obamacare reform into the tax reform and the infrastructure will sort of maintain the market momentum a little bit. Beyond that, the economy is really still very robust, although moving at a pace that allows the Fed to continue to raise rates slowly.
But you also see opportunities in European markets?
Yes, we've seen some shift into the European markets. One of the reasons is that the European economies are really displaying some robustness and it's lasting. The other one is that there are still good valuation, but also that the political risk has receded somehow after the Dutch election. There remains such a risk, especially in France, but we feel more confident.
Robert Ruttman, Werthstein Institute fellow in Zurich. What do you think about the current valuation of the stock market?
I see the current valuation is unjustifiably expensive. The most conservative valuation metric to my mind is the Shiller PE, which minimizes the fluctuation of earnings over the cycle. The current Shiller PE level for markets is 29.3. Now, this is the 3rd highest level in history and represents a 75% premium to what investors have been willing to pay for markets over the long term. To me, that's simply too hot to handle.
But despite the high valuation, we don't see a correction. Why?
Well, I think that investors are in a certain state of euphoria, if you will. Recall that the current bull market is in its 7th year, making it the 2nd oldest bull market in history. And no one knows when it will end, but everyone knows that it cannot last forever.
Giles Keating, despite all the problems, US stock markets have been steady in March and in Germany the DAX rose. What is currently keeping investors engaged?
Well, of course, the US market went up strongly in January and February, but then really became directionless in March. The German market picked up a bit of the slack and carried on in March, but in recent days has looked again a bit more directionless. So I think the trouble is that markets had gone up so much already that investors are now beginning to get concerned that they're a bit overvalued, that they've gone up too much recently, And I think that, along with worries about rising interest rates, as well as general political worries, does mean that markets now could be directionless or even at risk of going down in coming weeks.
Asking a pioneer in the fund of hedge fund business and financial market expert Sanjit Talukdar in London. What are your thoughts about the markets?
Well, Stefan, the markets have had a good run. Many indices are up this year. However, there are risks to sustain momentum in the markets. There are risks that interest rate increases by the Fed will surprise on the upside. And there are many risks of nascent protectionism, enormous changes, Brexit and such like in the world. And I think the risks are for a correction. So I'm cautious.
And when you now would have to vote on a scale from 1 to 10, what would be your vote?
Well, it's difficult to time the correction. It's difficult to time this. And of course, there could be momentum a while yet. But I would still on the side of voting perhaps for a 4.
So, Sanjit Talukdar voted with a 4, which however is not included in the Werthstein Index. It's a lively representation of the Werthstein Institute's market opinion. It expresses the individual voting members' expectations for the development of global stock markets over a time horizon of up to 3 months as the average of their votes on a scale from 1 extremely negative to 10 extremely positive. Look at the current votes.
Well, in this context, I want to be more neutral and I'm voting for a 5.
Well, I've increased my vote from 2 to 3. And this is mainly in recognition of the slightly firmer macro data, especially with respect to employment, wage growth, and also projected earnings.
Well, for my own vote, I'm sticking with a 2. And if we combine that with those small improvements that Valerie and Robert have made, that gives a total of 10. So if you take an average, that's 3.3, which is a little bit higher than the 2.7 we had last month. So still cautious, but not quite as cautious as a month ago.
It was a historic moment. Last week, Britain's Prime Minister Theresa May signed the papers triggering the UK's divorce from the EU and sent them to Brussels. Britain has thus formally initiated the process of leaving the European Union, which is due to take 2 years. During this time, the terms and conditions under which Brexit will take place will be negotiated, and in March 2019 we'll know how this European War of the Roses will end. The bargaining for billions has begun.
Coming back again to Giles Keating in London, the official process of Brexit was started. Short term, we have seen no real effects on the markets. But what are the long term? Will we see a war of roses or a friendly agreement at the end of the process? What do you think?
Look, this is the crucial question. If it really does turn into the wars of the roses and you get a real battle, then I think that can be negative, both for the European Union and for Britain. And if, however, we get a good deal emerging, then I think the economic consequences will be quite small. There may be even 1 or 2 good things that can come out. So the markets will be focused really on the information as it comes through. And I think if, for example, there was some point over the next 2 years where it looks as though things are about to break down, that could have quite a negative effect on markets for a while. And only when they manage to get it back on the road, which I think they eventually will do, would you then get a recovery.
We won't know what Brexit really means until March 2019. But in the meantime, there will be lots of new information, and each month we will bring you the latest opinion from our experts on the markets. The Werthstein Institute stays very cautious in April. However, the situation is no longer quite as negative as at the beginning of the year.